single-digit gold-silver ratio returning as a higher than priced for probability overall. Let's be clear, if you're going to run 333, but you then overshoot to a $1,500 or a $2,000, remember, markets overreact in the opposite direction. Everyone suddenly becomes silver is the god money and overreacts. There is a point where I will sell this. There is a price point. I don't know what the dollar represents at that time. I don't know what currency will be in force at that time. If it's still a dollar, a digital dollar, something else. But when measured to old dollar terms, it will be in 4 digits. I have quite high expectations for that event.
Silver's endgame is rarely calm, and history suggests the final phase is defined by overreaction rather than precision. As the gold-silver ratio compresses towards single digits, price behavior tends to accelerate violently, overshooting fair value before the cycle exhausts itself. Francishunt frames this in terms of probability, not hype. Prior bull markets show that once silver clears primary resistance levels, it rarely stops at conservative targets. A projected move toward the $300 to $333 zone is viewed as a midpoint, not an end. In late cycle conditions, Hunt argues markets routinely overshoot by multiples, pushing silver toward $1,500 or even $2,000 in old dollar terms, as investors abandon ratio discipline and chase monetary safety. He stresses that the exact currency unit may change, but measured against today's dollar framework, 4-digit silver becomes a logical outcome of excess liquidity, distorted ratios, and emotional crowd behavior. That moment, he notes, is where disciplined selling begins, not buying. Now, we present the clips from Francishunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
My overall impression is that we're in the contagion part of the correction in the gold-silver ratio.
Okay.
So this is rolling over. Most rallies are followed by downside continuation. You can see it there. And we said 65 was the key level, and it should be run. That is a triggering of a kind of a macro head and shoulders that we have on a much bigger time frame, technically, that we've drawn many times on our own channel and we remind people of. It's not the most beautiful typical structure, but it is a structure. And you can see 65 was key. You went as high as 126, and then you are in a real triggering event. You've triggered at a downside event here, which has a very, very deep repercussions that should see you run to 32 just on that technical pattern, and then further overperformance and reversal on that. So we actually see a single-digit gold-silver ratio returning as a higher than priced for probability overall. And that means, to answering the question again, is it too late for silver? Well, if it's going to $1,200, does $82 sound too expensive for something that's going to $1,200?
You're gonna wish you bought more.
And the other thing you wanted me to address is the law of the parabola that we referred to very specifically. And this is the exponential chart that actually the largest part of your money is actually made in the last 5 to 10%. You'll make 50% of your profits in that final 5. People will sell too soon. So let's be clear, if you're going to run 333, but you then overshoot to a $1,500 or a $2,000, remember, markets overreact in the opposite direction. Everyone suddenly becomes silver is the god money and overreacts. There is a point where I will sell this. There is a price point. I don't know what the dollar represents at that time. I don't know what currency will be in force at that time. If it's still a dollar, a digital dollar, something else. But when measured to old dollar terms, it will be in 4 digits. I have quite high expectations for that event. And here's the other thing I want to just introduce that's slightly unscheduled that we didn't discuss, but there is real opportunities to maximize this particular game. I did an emergency check-in with my community on this. There are some advocates that say on the precious metals market now, when you look at the straight line up, let me just hide any lines I've drawn, they'll say there's no cheap entries in here when you're on a parabola now. And in one level, they're absolutely correct. on the monthly or the 6 monthly time frame that I have you on, where do you enter? If you bought now, where do you put a stop down here? Well, you can't do that. You needed to have bought a lot sooner. My key point is the gift of multiple time frames means you continue to get entry opportunities in smaller time frames. And I've left a broker platform that I actually use with trades. You had a pullback here, and that was Bitcoin rotation trade. Do you remember that one? Everyone saying gold's top, silver's top, Bitcoin rotation trade. What did we get? We got on this daily time frame an opportunity to re-enter. There are 2 entries I put on. I would have had stops down here. I would have been entering them here on what we call the relative low 2 and utilizing HVF method in what is a macro bull on lower time frames with stop losses. Those stop losses are now up here, by the way, with guaranteed profit locks, in case you're wondering where they are. We entered further entries, and those are now sitting deep in the money. You've got about 150 there, you've got about 305 there, and we are going higher.
The gold-silver ratio appears to be entering the contagion phase of its correction, where technical signals and momentum begin to reinforce each other. A decisive break below the 65 level has triggered a large macro reversal structure, opening the door to a decisive move toward the low 30s on the ratio, with scope for further overshoot. Historically, this phase is where silver begins to outperform aggressively, not gradually. Once parabolic conditions take hold, the majority of gains are typically concentrated in the final stretch of the move, with as much as half of total profits occurring in the last 5 to 10% of the cycle. Price targets near $300 may only represent an interim zone, as market psychology often pushes valuations far beyond perceived fairness. In such environments, pullbacks on lower timeframes tend to offer repeated entry opportunities, even while the broader trend remains firmly bullish. Volatility increases, sentiment swings sharply, and positioning becomes decisive as the move accelerates. Let's get back to the interview.
The silver price on a quarterly basis that runs you back to the 1950s all the way along up here. And I was discussing squeezes as a volatility constriction that tends to bring the springboard of future massive moves. So we've actually had the technical support for the fact that there was a major breakout coming for silver. Typically, we would buy the breakout there and put the stop loss there. However, as I was mentioning, you often get a gift within a gift, and the markets love you. I teach people the markets love you. You're just not seeing the gifts. We are like blind animals walking on pearls and gold and diamonds when we are in the markets, because the market wants to love you, wants to give you gifts, and you just got to bend over, open your eyes, and pick them up. So that was a squeeze within a squeeze that saw actually you should have got leverage long at 25. You would have had a super tight stop, and you're waiting for a target that we have at $333, which will not be the high, but it'll be a resting point where you'll probably pause for a period of. And we've done that draw.
So consolidation would come around that time.
Yeah, a period of consolidation. In terms of calling the final top, it's not that. Let me be absolutely clear. So we have the 330 over there. It's generated from HVF method. I'm not going to put you through the process of how we do the draw. It will kill time. But people can come and check out how we do all of that by booking a chat for a call or anything if they want to find out more. But we have a target of 333, but we have overperformance expectation. So we usually just do a partial close of around 50%. So when do I sell silver? Because your question was, should gold guys rotate in, or have silver guys overstayed their welcome and should they be getting out? Yep. So let's also focus on answering your question, which you asked. And the answer is the exit for silver for us is going to be determined by the gold-silver ratio. Now, the gold-silver ratio has been, during the financialization of everything, excessively lengthy. I'm getting the wrong one here. Let me just get one that has more history. Not so sure. Let's go monthly. There we go. And let's go Oandas. So here we can see that this is correcting, but this is insufficient history. This is running us back to 2007. In fact, this is all capturing the cycle of the financialization of everything.
Yep.
That had its first run, Vietnam War, pre-Vietnam, Gulf of Tonkin 64 to the 71, and the finishing of the Vietnam War probably officially at 74, although there'd been many withdrawals already by then. So you have that sort of decade of there. None of that is in the view. This has been the financialization of everything, where silver was suppressed relative to gold. So you have insufficient data. I'm saying to you that in actual fact, fundamentally, and on many other measures, Egyptology, it was 8-1. Other measures have been 15-1, 10-1, 12-1, variously around them. There's been one or two more recently during the financialization era that had 30-1. But that was still part of the suppression of silver era, when there was large amounts of silver above ground that could still be leaned on to be utilized. If you have excess inventory, you can always allow valuations to stretch on one of them being devalued because of that inventory. Once you've run it down, which is pretty much where we're at, and everybody says if you don't hold it in a vault inside your own country's borders, you don't have it, and there's now a run, you end up with a problem. And the supply side has been suppressed during this period. Actually, 60 to 70% of silver supply is as a byproduct. So that actually means you don't have very many dedicated silver miners. You have 30 to 40% of your total supply is coming from someone whose specific business is to extract silver. And that's a real problem, because people don't do the byproduct. They're less interested in the byproduct. They're going down for the zinc, the gold, the copper, the iron ore, or something else. And that's okay. While we've already spent the energy, this is kind of useful. We'll take that out. They're not digging there because of silver. It's very hard to forecast.
Yeah, they're not going to ramp up more to get to that byproduct. It's just not going to happen.
Yes, and they can't forecast for it. It's a random byproduct. It's just there. If we see it, we see it. If we don't, we don't. So it's not a silver enriched area. And what the problem is, there are mines which have silver ores of reasonable quality, or certainly places where silver is known to be, but it's not been financially viable to do, because the energy involved in digging a hole in the ground to extract silver is too much for the price that's on offer. And the only thing that fixes this is price.
Yep.
And now, as we get pushed towards the iPad car, the iPad everything, the battery world of everything, everything is a rechargeable battery, because it can come with surveillance grid software based in it. They want to remove your gas stoves and everything. You know, we're being pushed into this world. Well, the darkness of that surveillance grid decision to have us all in Tesla type cars, as the iPad cars, as I call them, is the gift for the silver market, because solid state batteries will now do 900 kilometers. That's a great range. I tend to like 1,000 Ks as a range, and you're not filling up very often. I have a big old Range Rover that chews diesel, a big turbo V8. I'm hated by the eco guys, but I can go all the way into Namibia from South Africa on one tank. And you know, now you're getting battery cars that can do that and do an 80% charge in 8 minutes. That's probably how long you spend at a petrol place when you grab a P and you fill up your tank. So, but that would require 20% of, if we just went to a 20% share of those supremely superior batteries, would require 100% of current production of silver. That means no silver for solar panels, no silver for anything else, no silver for devices. Don't forget, they run hot in these, they run hot in missiles. Everything is now consuming more silver.
Silver's long-term quarterly structure, dating back to the 1950s, shows a classic pattern of volatility compression that historically precedes explosive repricing phases. Extended squeezes tend to store energy, and when they resolve, price does not drift higher, it launches. That structural breakout is now reinforced by supply mechanics that cannot respond quickly. Roughly 60 to 70% of global silver output is produced as a byproduct of mining for other metals, meaning supply does not rise just because price increases. Only a small fraction of production comes from primary silver miners, which creates an inelastic supply problem that price alone cannot resolve. From a technical perspective, the breakout projects a central resting zone near the low $300s, a level that would likely serve as consolidation rather than a final peak. Historically, silver does not top based on price alone, but on relative valuation, especially against gold. The gold-silver ratio has spent decades distorted by financialization and excess above-ground inventory, conditions that are now reversing as physical ownership. Once inventories tighten, ratios that once seemed impossible can normalize rapidly. On the demand side, silver's role in advanced batteries, electrification, defense systems, and high-heat electronics is accelerating. Even partial adoption of next-generation solid-state battery technology would absorb the entirety of current global silver production, crowding out solar, industrial, and consumer demand. Price is the only mechanism left to ration supply and signal expansion. This is a market transitioning from suppression to discovery, where pullbacks become gifts inside a dominant trend. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.